Hello friend, we are looking here SYBCom CBCS pattern 2019, Business Economics Macro, and under this chapter number 1 Money, we complete the 1.1 and 1.2 in the previous 2-3 lectures. Our next lecture is about the 1.3, the supply of money, credit creation of commercial bank. So let us start with our point. So in this chapter there are the various points like the meaning and function. We already completed demand for money. There are classical approach and Keynesian approach. Today we start the new point, the supply of money, the credit creation of commercial bank, the money measures of RBI, and then credit control method of the used by the central bank, quantitative and qualitative tools. And last one is about the value of money. There is two theory, quantitative theory of money and the cash balance approach. There is the Marshall, Pigou and Robertson and Keynesian view about the Cambridge approach or the cash balance approach. So 1.3 is the supply of money. The supply of money is mean the total money into the circulation of the economy. It's called the supply of money, and money supply is play crucial role in determination of the price level and the rate of interest in economy. So who does decide the total money supply in the economy? There is a two important component. Is the one is the government and another is the central bank. Both are the decide the how much money supply is created in economy and how much need to control. Besides of these two components, means the government and central bank, the commercial bank also play important role to supply of money and credit creation. So we looking here the credit creation which is created by the all commercial bank through their functions. So commercial banks organize the financial institution that deal with the business credit, the borrowing and the lending of money. They borrow from their customers and lending money to the other customer. The credit of the bank important to create this credit money. So this is called the credit or credit money. So bank is accept the deposit and lending the loan and advancing the loan to their customer. This is their function is the credit creation. So the money which is being created by the other banks than the central government and the central bank, it's called the credit money. So other than the government and the central bank, the money created, it's called the credit money. So the credit creation and the credit deposits is one of the most important function of the commercial banks. So we looking here the process of credit creation, how they create the money in their functions. So the bank accept the deposit from their customers and sanction loan and advances to their customer. These two functions means the multiply expansion of deposit and loan are called the credit creation or the creates the credit money. The credit creation depend upon the deposits of the bank. The deposit accepted by the bank creates the liability and loan extended to customer creates asset. The modern banks create the deposits in two ways. The first the primary deposits and second is the derived deposit or secondary deposits. When the bank open the deposits account of the customers, it's it's called a primary deposit. When the customer open the account in the bank and bank create the deposit in his name, it's called the primary deposit. Second is the derived deposit or secondary deposit. When a bank grant a loan to their customer, it is not pay into the cash form, it is open the account on the name of their customer account and it's called the derived deposits. So based on this system, the granting of loan, it said that every loans create the deposits. So every loans is create the secondary deposits or derived deposits. So this important function of the bank accept the deposit and advancing the loan. So the ability of bank create the credit depends on the fact bank need only a small percentage of cash to out of total deposits, and how much money hold in their hand, it is generally is a 5 to 15% cash hold by the money by the bank, and other money is given to the loan to others, and this function is create a multiple way of money. And the deposit of multiple depends upon the required of reserve ratio, is basis of credit creation. How much cash is hold in hand and how much cash reserve ratio is kept outside of the amount is decided by the central bank of the country. And it should be remembered that the magnitude of deposit multiply depend upon the cash reserve ratio, is it decided by the central bank of country. And in our country, the RBI decides the cash reserve ratio, how much cash keep the outside in proportion of the time and their the demand deposits. The greater the cash reserve ratio means the lower the value of the deposit multiplier. And in other words, increase the cash reserve ratio will be lead a contraction of credit creation. The more amount kept outside means the less credit creation, and more distribution of the loan means the more credit creation. Less amount of CRR kept outside means the more distribution loan and more credit creation. So it's a called a credit creation. So bank accept the deposit and advancing loan, and throughout that advancing loan and the lending loan, they create a multiple way of account, and the distribute the loan to the people, and it's create the multiple way of money. For this, there are certain assumptions. There are number of banks functioning in the economy like X, Y, Z, A, B, C, D. The Bank of Allahabad, Bank of Baroda, Central Bank of India. There are many banking into the economy assumed for credit creation. The service of banks are fully utilized by the customer, and all transactions are routed out throughout the bank. So all transaction of the economy throughout the bank is completed, it's assumed. The next is the bank have maintained 20% cash reserve ratio with respect of their total cash. So the next is the initiated, or the first bank is have the 1 lakh rupees the primary deposit in their account, and the loan amount drawn by the customer, one bank deposit in full in the second bank includes the third bank. So whenever customer withdraw the amount into the bank, is fully deposit into the another bank, and when withdraw from the other bank, fully deposit this withdraw amount in the third bank as per our explanation. Each bank start the initial deposit, primary deposit, and deposit by the debtor of the bank. So how the multiple way of money created by this bank in this their function, we looking here the process of credit creation. So process of credit creation, here we shall illustrate that the 1 lakh rupees the deposit by the one customer, and banking system will expanded this 1 lakh rupees to the 4 lakhs, and means create the 5 lakh rupees into the banking system throughout their functions. The banks, like the other business firm, show their the financial condition into their balance sheet. So into the form of the balance sheet, 2 sheet columns, the one is the asset side, one is the liability side. We can explain the balance sheet, liabilities and assets are equal, and there is the how the bank create multiple way of money. For our example, we looking at the 1 lakh rupees the whole first bank in their account, and the basis of they given the loan to the other customer. So bank A balance sheet, the asset cash is 1 lakh, means the deposit the customer 1 lakh, it is the liabilities, because after some time the customer demand his money, so it is the liabilities. So the balance sheet of A bank, there is the cash in hand the 1 lakh rupees, so liability side 1 lakh rupees, loan is given to the other customers the 80,000 rupees, because the 20% is a CRR, cash reserve ratio. So new deposits, the derived deposit or secondary deposit create is the 80,000 rupees. So total asset sides 1,80,000 and liability sides 1,80,000. So balance sheet, here the cash of the 20,000 held by the bank as per the cash reserve ratio. The original deposit 1 lakh, loan is given the 80,000, new deposit is 0, 1 lakh is equal their asset and liability side. So when we looking the bank B balance sheet, that time the customer deposit this all 80,000 rupees in his account. So 80,000 for the B bank is the cash asset sides, and deposits is also 80,000, which is the liability. The customer X is deposit into this B bank. Loan is the 64,000, 20% amount will be cash reserve ratio, and remaining amount 64,000 is available for the loan. So the bank B balance sheet, the 60,000 is cash reserve ratio as per the 20%, deposit the 80,000 rupees by the ex customer. So 64,000 is available for loan for the Y person, and this Y person is deposit the money in the next bank, and how much money will be created throughout this credit creation is explained with the one formula. So when the C bank get the 64,000 rupees is required to 20% kept outside the as per the central bank regulation CRR, and amount of is the 51,200 will be lent out, the invested by it, and this is the continuous the deposit money and given loan when till to the 1 rupees is the remain. So from this process, how much money is created by the commercial bank, it is the explained with the this formula. The 51,200 by the C bank put process of expansion deposit will not stop here. It is still continue to when the remain of 1 rupees. So it will be go on the money lent out. The one bank is spent through the check, and these checks are deposited the other banks. So till to the total deposit of the bank is create 5 lakhs from the 1 lakh rupees primary deposit. In all the banks, including original deposit 1 lakh, it's create the 5 lakh rupees from the 1 lakh rupees deposits. So deposit multiplier can find out the how much money create with this credit creation process. The DEM means the deposit multiplier is equal to 1 upon R, and 1 upon R is the equation for multiple credit creation process. So when we are now the position to state the how many deposit have been created by the bank system out of the currency deposit 1 lakh rupees. So 1 lakh rupees the first, the primary deposit 80,000 is into the B bank, 64,000 into the C banks, and then 51,000 is again given to the D banks and other banks. The total create the 5 lakh rupees. So how the 5 lakh rupees is the created from the 1 lakh rupees, it's explained with the this deposit multiplier. Deposit created by the banking system means 5 lakh minus the primary deposits is equal to 4 lakh. So 4 lakh is created, and should be remain that the magnitude of the deposit multiplier depend upon the cash reserve ratio. How much money is created, it is depend upon the cash reserve ratio. So into this diagram form we can explain this money, how much money is created. Initially 1 lakh rupees, then the 20,000 is cash reserve ratio kept outside, 80,000 rupees is given to the X person. This 80,000 rupees the X person deposit in his B bank. The 80,000 out of the 60,000 is rupees the hold by the bank cash reserve ratio, and 64,000 is given to the Y. His Y person deposit this 64,000 in his bank C. C bank hold the 20% amount, means 12,800, and remaining 51,200 is given to the loan to the Z person. This Z person deposit into the D banks. So this way the multiple credit creation process is the continue till to the 1 rupees is the remain. So this way create the 5 lakh rupees from the 1 lakh rupees primary deposit. Suppose here the cash reserve ratio is the 10%, the 1 upon 10 means 1 upon the R, then deposit multiplier 1 upon 1 means 1 upon 110. So in this case, the initiated deposit some amount of banking system will lead to the 10 times expansion total deposit above figure. So in our previous example, there is a 20% of cash reserve ratio. So there is a 5 times the create a multiple credit money from the primary deposits. So our example, there is the deposit multiplier is given D upon R, 1 upon R is the formula. So 20% is the cash reserve ratio, means 0.20 means 1 upon 5. So 1 upon 5, so it is the 5 get the answer. So 5 is the multiplier, R minus D is equal to multiple credit creation. So R means the CRR, cash reserve ratio. We find that R the 5 and primary deposits in our example is 1 lakh. So 5 multiplied by the 1 lakh is equal to the 5 lakh rupees create through the multiple credit creation. If there is the 10 is answer, 10 multiplied by the 1 lakh, so 10 is the answer. So 10 multiplied by the 1 lakh means the 10 lakh rupees create through the multiple credit creation. So how much money is created, it is depend upon the CRR, cash reserve ratio. So this way the bank create the multiple way of credit creation, but every time it's not happen the multiple way creation of money because of the certain limitation on the credit creation. What are the limitations on this credit creation? So we discuss here the limitations on the multiple credit creation. First, cash reserve ratio. When the cash reserve ratio is more, the less credit creation created by the commercial banks. And less cash reserve ratio means more loan distribution and more credit creation. So as per the Reserve Bank or the central bank guidelines, the how much CRR is decide the amount of multiple credit creation. So more of CRR means less credit creation. Second thing is about the amount of cash or legal tender money. The basis of the legal tender money or cash or primary deposit, bank create the secondary deposit and it is the create multiple way of money. So less amount deposit into the bank means less credit creation, more amount deposit the bank means more credit creation. The next thing is about the economic climate, how much economic climate and how the economic climate in the economy. Suppose there is the pandemic situation in economy, there is the worst condition for the investment for the businessman, and there is the no good climate condition in economy, deflation situation. So there is the less loan demanded by the people, less loan distribution and less credit creation through of the commercial bank. So credit creation is depend on the economic condition of the economy. The next thing is the banking habits of the people. If the people use the more cash instead of the bank money or the check, that time the less credit creation. If the people use the bank for their transaction, there is a more credit creation throughout the bank. The next thing about the limitations on this credit creation, there is the lack of proper security. If there is a more security available, then people take more loan. If there is a no security, like the developing country, there is the lack of the proper securities or the below poverty line people, and most of the people have no any asset for the security. So lack of the proper security, there is a no taken loan, no taken of the loan means no multiple way of credit creation of money. Next thing is of the credit control by the central bank. If the government and the central bank thinking that the credit control, they increase the CRR and reduce the money supply into the economy, that time less credit creation. If they think that there is a need to the increase the money supply, they reduce the CRR and increase the credit and loan in the economy. So credit control by the central bank is affected to credit creation function of the commercial bank. The next thing is about the lack of clearinghouse facility. The lack of clearinghouse facility in the developing country, there is a no clearinghouse facility, discounting or rediscounting of bill facility. So there is a less credit creation. If there is a facility is available, more loan taken by the commercial bank from the market and given to their customer and more credit creation. But in India, there is the lack of clearinghouse facility. The next is a statutory liquidity ratio. This ratio is respect of their total hold of gold and bond and shares and securities. If the more amount keep the outside the away in respect of their total liquid asset, so less loan taken from the market basis of this liquid asset, and less loan distribute, and less loan distribute means less credit creation. So ability of the statutory liquidity ratio means ability of the liquidity is also important. More SLR, they reduce the credit creation. So this way we see the multiple way of credit creation. So it is generally presumed that the money supply determine the policy of the central bank of country government. Beside of that, the commercial bank also play the important role to the credit creation. The credit creation or credit or deposit one of the most important function of the commercial bank, and the money which being created by other than the bank of central or the central government, it's called the credit money. The bank accept the deposit from their customer and sanction the loan or advancing loan to their customer. These two function is create the multiple way of money, and this way so people demanded money from the banks. So bank is not hold a total percent of cash in their hand, and as per the requirement, as per the government rules or the central banks guidelines, they keep the 5 to 10% or 5 to 15% cash, and other remaining money is given to the loan, and this function create the multiple way of credit creation. The deposit multiplier depend upon the required reserve ratio, which is the basis of credit creation. The greater of cash reserve ratio means the lower value of deposit multiplier and lower credit creation. In other words, increase in cash reserve ratio will be lead to contraction of credit creation. Reduce of CRR means the more credit creation. So thank you. Here we looking the references for your study. The M.L. Jhingan macroeconomic theory for your study, and Prasad G, P.Adhav, Bhotekar, Gola business economics, Sem-IV. This present publication book is also available for your study. Thank you for watching this lecture. Next time we will be looking next point. The assignment question on this point. The next question, the explain the process of credit creation will be asked for 10 marks, and write a short note on the limitation of credit creation. It will be asked for the 10 marks. So two questions asked on this point. Explain the process of credit creation and write a short note on the limitation of credit creation. So thank you for watching this video. The next time we will be looking the next point in the next lecture. Thank you.